Bill, great to have you on the show. What's your thought on the report this morning?
Well, Oliver, I think everyone is very happy, and the markets are certainly very happy that the employment situation seems to be improving. The unemployment rate is high, but it's getting better. I think what we're underestimating is the degree to which there are still some zombie companies being created out there. A lot of the restaurants are never going to open again, and they may be continuing to employ people because of the PPP program. But let's face it, the world of post-COVID-19 is going to be one where there's going to be less personal contact. There's going to be much more remote computing and remote work. Those are the kind of changes that I think is not being appreciated right now. Retail, hospitality, education are the sectors that account for most of the employment gains. But as a consequence of that, we see a lot of low-wage jobs being created. In fact, you can see that in the average hourly earnings. When was the last time you saw average hourly earnings go down? And that's all compositional because of the type of jobs that are being created, the low-wage, low-productivity jobs. And going forward, what worries me most is to the extent to which the U.S. economy can adapt itself, invest enough in remote computing, in remote working facilities to be able to get us going again.
Bill, is there still within that, though, a presumption about human behavior and activity? What do you think we've learned so far about how folks respond in the post-COVID world? It seems like some are a little too eager to go out.
Absolutely. In fact, the concern that people underestimated, the degree to which people have a pent-up demand to socialize, and notwithstanding what I said about having to stay further apart, the offsetting behavioral aspect of this is that people want to relate with other people. And so we're going to have to learn to relate in a way that's different than before. We can't go up and hug each other anymore unless we're convinced it's safe to do that. And so the presence of vaccine and COVID treatments is something that'll influence that. But I think going forward, just as the world going forward after SARS and Hong Kong hit, people start to react differently, and the degree to which people are able to get close contact or want to have close contact anymore is going to change.
So right now there is the imminent scenario, which is COVID still exists. These precautions have to be made. That's a different type of behavior, and that's a different type of economy. So that could potentially change if there's success on the vaccine front, but that's basically a scenario that we can't really price in right now because we don't know when, we don't know how or if it's possible, but we don't know. So in this scenario that we even have, though, Bill, I'm curious, as we see that big spike in unemployment start to come down, should investors be treating this the same as coming out of any other recessionary period, which is a pretty good time to invest?
It's a pretty good time to invest if you understand that we need to have investment in technologies that will enable these jobs to be permanent jobs. We really don't really want jobs that are just purely delivery jobs and low-wage jobs. In fact, we want to be able to have jobs where people can make use of Zoom and other technologies of remote computing. So I think the investment emphasis, and I think the market has got it right in the sense that if you emphasize the chip technology companies, the remote retailers like Amazon and the NVIDIAs, who are the graphics chips of the world. I'm mentioning these names not so much because I'm pushing them, but only because they represent, I think, the forefront of where new investment technologies have to go and where the world is adapting our economic functions from the pre-COVID world.
Is there going to be enough in that part of the economy, this burgeoning and expedited tech economy? It was already there. It was already the best place to be from a stock perspective. Now we're just kind of pushing a lot of it forward. How much visibility do you have into what kind of growth there is there? I mean, if that's going to create jobs, if there's going to be more data centers being built, if there's going to be XYZ tech roles, then do we just have a different type of economy that is more futuristic, pushed forward?
Very much so, and that's where I have my doubts, because the degree to which the U.S. economy can adapt and how fast it can adapt is something that's still up in the air. Let me contrast it with what's going on in Europe. In Europe, you hardly see any change in the unemployment rate, right? You see about 500,000 increase in unemployment, and there it's because the composition of the economy has flipped from private employment to government-sponsored employment, whether it's through zombie companies, government-sponsored companies, government-supported companies, or just outright government payrolls. So in that sense, the European economy, even though people are now talking about how investable Europe has suddenly become because it's doing so well in terms of maintaining its employment or containing unemployment, I think people are misled by those raw aggregate numbers. If you look inside what's happening, and do we see the kind of changes in the composition of the European economies that you see in the US, that's where the contrast is. And as much as I am saying that we are shifting slowly, the other economies in the world are not shifting at all. By contrast, China seems to be shifting very rapidly to the e-commerce type world. So we are bracketing ourselves between two very large economies where the speed of change and direction of change is going toward the more capital intensive, information technology intensive, high skilled labor intensive production that we need to catch up on.
So Bill, it sounds like there is an opportunity there that could be seized on, that maybe is happening more sluggishly than it should. Maybe this can expedite some of that adoption of a new tech economy. But there's also this other force, which is basically right now there's a bunch of debt being taken on by a lot of these companies. You've got a chart showing that productivity declines with that increase in debt. So it's almost like we need to have an even faster engine to be able to work through this. Is that possible then, if we can adopt that technology and create a sort of a way to get a ramp and get out of this situation? Or is there just too much of a gravitational pull now from all this debt we're taking on? Like, can we get the economy to an escape velocity to survive the burden that's coming on these companies?
I'm so glad you're showing that chart, Oliver, because the research I've done since leaving Citi and the IMF and the Fed and working at Milken is that Mike Milken has made me very aware of how important a firm's capital structure is in incentivizing the managers to invest in different technologies. And I think the way the Fed works is one where they're promoting lending, they're promoting debt-based financing, whether it's through bank financing or through now the Fed has gone in and actively supporting the bond market by actively being a buyer of a basket of bonds. By having more and more debt loaded onto companies, managers are incentivized to worry about paying back the debt. So they're not going to go for the high productivity, high technology type investments that could be riskier, but boy, they'll have big payoffs. Instead, they're going to say, let's do the same old thing that we knew worked before. And that's exactly the wrong thing to do, because what worked before is not going to work in this post-COVID world. And so I worry that the Fed transmission channels, the Fed monetary policy mechanism and analytic framework, which we're all familiar with, is so debt finance based. And my proposal has been, in a paper I posted, is to be able to say, let's incentivize the Fed to buy baskets of equity. Right? We don't have to have the Fed be a venture capitalist or private equity investor. All we need to do is to incentivize and lower the cost of equity financing relative to debt financing. That alone will tell managers, hey, swing for the fences, invest in technologies where you think you're going to get the biggest bang for the buck, and let's go for the highest returns possible.
So you're saying that through equity funding and as a way to raise cash at companies, as a way to spend, is shown to be what a more productive use of money? Is that something that we know will say, hey, if we're able to incentivize in a different way, that these companies and these CEOs will spend it differently? I mean, is it not just cash is cash, depending on how they get it?
If you get the cash and you got to pay it back, and all the guy cares about who's getting it back is how much money he lent you,
right,
then you'll be incentivized to do the same old stuff that works. If instead the investor is an equity investor and says, I want to have the maximum growth possible, I want you to make the biggest possible returns because I'm going to share in those equity returns, then the cash, that same dollar you got, you're incentivized as a manager to say, let's put it to work in new technologies.
The swing for the fences.
Exactly. And if I fail, that's okay, because the equity investor knows that's the risk, because that's the potential reward that they're going for.